Have you heard about the Federal Reserve cutting rates? Are you wondering how could that affect my retirement? In this episode, we go through all the details.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement podcast. We are glad to be able to talk to you today, especially on a topic that you probably have heard about, and you wonder, well, what is this going to really mean? And the topic is the Fed just cut rates. They went down 25 basis points, or 1/4%. And you might, if you are somewhere within maybe the banking world or whatever, you might have just gotten notification that your interest that you're earning is going to go down. And we wanted to talk a little bit about that today. This has been an environment that we've not seen in many years. I've been doing this business for 25 years, and we've not seen interest rates as high as they've been for the last year or so in that whole period at that rate. And so it's been a really fun time. And I say fun in the context of, you are getting good rates. We are getting good things out there. And so the problem with things, though, is that if you have high interest rates, a lot of times that could translate into high inflation. And that's the reason why you saw those rates go up like they did, is because the Fed was trying to control or manipulate uncontrolled growth or inflationary problems. And so you might say, well, we've had clients in here saying, hey, I'm paying more for groceries. I'm paying more for whatever it might be. But I'm earning more. And it's been nice to see if I've got cash in a bank, I've been able to see that outcome. But we are now seeing that kind of start to come back down. And there is talk that that rate is going to continue to go down. And I think right now, kind of the target's around that 3% mark. Right now, we're at 3.75 as far as, right? Is it 3.75?
It's in that ballpark.
Yeah, in that ballpark as far. But anyway, that's kind of the target. So anyway, we wanted to chat about that today. Anything else there on the setup, Merce, of what we're trying to discuss?
No, I think that's really it. Big picture is we want to talk through, well, the Fed just cut rates. And so what do you do now as someone that's planning for retirement or already in retirement? And a lot of this is going to kind of speak to maybe investment strategy a little bit. So, Rayden, why don't you just kick us off and kind of talk through the cash side of things? A lot of people, in a way, it's been easy money for the last couple of years because of how rates have been. So why don't you talk a little bit to that, and then we can get into more of the investment side of the stock market and bonds and equities and all that.
Yeah, as I said, you've probably already gotten adjustments. We actually have a relationship with a banking organization that gives very competitive rates without having to lock your money up. A lot of our clients are using that for multiple of reasons. But almost immediately after the rate cut, we got notification that the rate that we were going to be getting in the bank has dropped from 4% to 3.75%. It was pretty much the day of the rate cut. And so that's an effect. We hold cash in those banks and in those accounts for personal as well as the business. And so you kind of got used to seeing these nice interest rates, and now that's going to start to come down a little bit. What we hope is that if there were inflationary issues, that also is truly under control. What we hope we don't see is this scenario of the rate dropping and then the rate having to go back and forth. That could be a troublesome time. So right now, if you had maybe gotten a CD last year, and let's say you got that CD and it was paying maybe 4.5, maybe you've got an older CD that maybe even got up close to 5. When you renew, you are going to not see the same opportunity. And so that's the thing you got to be aware of. We talked a lot about that with clients, is that CDs are not a long-term play. But if you could get yourself locked in at a higher rate a couple years ago or a year ago, and you were able to lock that in, well, fantastic. But now we're in this new environment, and you're not going to see that. So you got to think, well, what am I going to do if I now am starting to see a lower rate? Am I going to renew again, or do I want to look for other ways to be able to save money? So anyway, we can now jump over into the bonds and equities, kind of the effects over there, Merce.
Yeah, so go back to that CD conversation, and you say, well, my CD is renewing. It was at 5%, and I got a good run out of it. Now they're telling me it's going to be 3.5 or 3.25, whatever it ends up being. When it comes time for renew, the decision becomes, well, do I renew at a lower rate, or what else can I do now that rates are kind of dropping across the board? And naturally, a lot of people will start to think to the stock market of, well, let me go into bonds and equities. And traditionally, or not, I mean, just more specifically, numbers wise, when it comes to bonds, bonds are really interest rate sensitive, and it's really unique. So, say you bought a bond, a couple years ago at the higher interest rate, and maybe it was a longer term bond, like a 10-year or 20-year or 30-year type of bond. Um, that particular one is going to benefit rather well from rates dropping because you locked in a higher rate for a longer period of time. That makes the value of that bond itself increase as rates drop. It's a way more attractive thing to have in your toolkit. And so the value of it's going to increase, which is a good thing, as well as you got a nice rate. So the income is going to be steady for the period of time that you're having that bond. But go back to that example of the person that is saying, the CD rate is terrible. I don't want this. I need to deploy new cash into the stock market, into the bond market. Well, you're not going to get that great rate that was there 2 years ago. You are going to get something that is more relevant to today's rates. And so a lot of times new buyers are going to be buying at a lower rate. And it's still that battle of, well, the CDs here, the bonds here, the bonds carry some risk. Is it worth it? And is it going to be good for the long run? Um, and so I think that piece is really important to think about. Traditionally, historically, go back to this evaluation of do I go into the bonds for a lower rate? Well, historically, a lot of people will say, let me just put that money now into equities and chase after a little bit better return. The problem with this, though, is we have to be very careful about how much risk we are incurring and adding to our portfolio because we don't want the lower rate. We want better growth. We say, okay, stock market's going to give us better growth. Equities are going to give us better growth, and we sometimes neglect the amount of risk now that we are bringing back into the portfolio to chase this better rate. So. I think that having that conversation with your advisor, if you don't have an advisor, that's a conversation we're happy to, talk you through as far as a balance of, safer assets and risk assets. And at the end of the day, finding that blend that's going to make good sense for you. Historically, though, there is this shift when markets do drop. I mean, interest rates do drop, that the equity side does benefit from that because there's a flow of money shifting over that way. So it is something to consider. But I think the bigger thing is you go back to this conversation where it all started. Rates are dropping. Cash is no longer effective like it was 2 years ago. And I don't want to up my risk. I don't want to go into the stock market. I've got enough in the stock market as it is, but I need something that's going to be safe and reliable and still make me a good, decent rate of return without the risk of the actual stock market itself. And I think this is where the opportunity truly lies. So Ray, now I'll let you speak to we call it the safety bucket, but there's a good amount of protections in there, not just from safety, but also from our ability to earn in this type of structure. So I think let's take a few minutes to kind of walk through that and the opportunity that we have here through the end of the year.
Yeah, I'm just going to start off and say, we talked about the bank situation where the bank just came out the day of and just lowered rates. That's a little different in the annuity world. Now, we'll probably start getting some notifications here soon, like very soon, saying that rates are going to drop. And just so you know how that works is that we will get a notification from XYZ insurance company, and it will say you have until this date to submit applications. Anything after that date, the rate is going to go down to X. And so we have not started getting a ton of those yet. We know they're coming. They are coming because when they drop the rates, that's how you're able to build these products, is to be able to have that higher interest rate. So with a fixed index annuity, just to kind of recap, basically what it does is it allows us to get a good interest rate based on an index. And an index, let's just for simple purposes call it the S&P 500. Well, if I were going to be looking at that particular type of index or that type of an annuity, I'm going to get up to a cap. Right now, we can have caps today at around 10%, is what we can have. Now, now that interest rates are starting to come down, we might see those caps start to come down, maybe to 9.5 or even 9. And so I'm going to just say right now is a little bit of a unique opportunity because you could lock in at a higher rate. If you were ever considering looking at the index annuity as an option, we call it a bond alternative. It's a way for us to get a good, decent rate of return without market volatility. And the reason why is because when the markets are down, I don't participate in the down part of the market. So I get safety, I get a good rate of return. And right now we are at an impetus point where, hey, if I'm going to hold these rates that where I'm at right now, now is the time to say, let's go ahead and pull the trigger. Now, I'm going to go back to this whole story, though. We are still at very good interest rates compared to where we were even 5 years ago. That cap I just told you about that's at 10%. 5 years ago, it was at 3. Mm-hmm. Okay. So that is, we're still in a very, very positive, good environment. We're just saying, hey, if I'm thinking about doing something like this, this might be the time to go ahead and pull the trigger because rates are going to go down. Now, I used to say this all the time when rates were really, really, really low, like at 1, maybe even 0.5%. Like when you go to the bank and you basically almost had to pay the bank to hold your money. I said, do you think the rates could go any lower? No, they couldn't go any lower because the environment's not there for it to be able to do that. It can only go up, right? Today, we're in the opposite of that. We've been at these really high rates. They really are not going to go much higher. And so they're going to just start to trickle down. And where they actually balance out remains to be seen on how the economy reacts to this. So long story short, I would say that you want to make sure that if you're looking at a fixed index annuity, you've ever had a conversation about it, you couldn't beat the timing as far as going ahead and pulling the trigger.
Yeah, I think, we will constantly have conversations, rate environment aside, around making sure that we've got asset allocation in line. And for us, we make it simple. Asset allocation is really dollars towards what we call the growth bucket, which is risk and the stock market. And within that, it has its own sets of asset allocations, and then dollars towards safety, which is kind of the safer assets, like Radon just mentioned, the fixed index annuity. CDs can fit in there when they're worthy, money markets when they're worthy, but those are kind of falling out of that safety bucket because they're just not going to be as productive. So those are the big conversations that I think, need to be had, especially right now as we're in this environment. And I'll say this, what I think we're really proud of here today is that we've got a lot of tools in the tool belt. And while Radon talks about fixed index annuities just now, that's not all we do. A big portion of what we do is manage in the stock market. We also have alternative investments that can provide income, that can provide growth, that is not related to the stock market. And so that list just goes on. What's nice about our structure, or let's say this, go to, a person that's only an investment manager in the stock market, and you say, what do we do? Well, the only option is we add more to bonds or we add more to stocks, and that's kind of it. Go to the insurance salesperson and you say, well, what do we do? Well, you just buy more insurance. In our case, what's nice is we just kind of, we look at it from a big picture perspective of what's the goal, and then what are the tools we need to put in place to achieve this goal around retirement and financial planning, but also around making a decent rate of return without taking on any more risks than we want to. So I think that's a really important thing to think about. It's no longer, as we approach retirement, into retirement, through retirement, it's no longer about getting the highest return. We hear that all the time from our clients. Today, it's way more about getting the right type of return that's going to make sure that we do have that peace of mind and that predictability in retirement planning. So anything else to add as we close out here, Radon?
No, I think, it's been a very interesting time of seeing rates go up to this. It's probably a once in a planning season that you'll see rates that high. But at this point, you're going to start to see them come down. So we might want to take some action. All right, everyone. We appreciate you listening to us today. We'll be back in here next Monday to give you some more information. Have a great week. We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable,
please subscribe to our YouTube channel and give us a like.